How much home can you afford? Watch this brief video from the loan professionals at First Mariner Mortgage for information on how financial pros calculate your home buying power. It will save you a lot of time in the house hunting process.
Before you start shopping for a home, you need to figure out how much home you can afford to buy. The basic rule of thumb to estimate the maximum price you can afford is between 2 and 2.5 times your gross annual income. That is, your income before taxes. There are two ratios that lenders use to determine whether you qualify for a mortgage. The first is the housing expense ratio, using the total of the principal and interest on your mortgage, plus real estate taxes, homeowner's insurance, and any mortgage insurance if necessary. That is your total housing debt, and it should not be higher than 30% of your total gross monthly income. So if your gross monthly income is $5,000 per month, and the total housing debt should be no higher than $1,500. The second ratio is your debt to income. First, add up all your reoccurring monthly debt, including credit card payments, loans, alimony, and so on. Then add your monthly reoccurring debt to your total housing debt. The total should not exceed 40% of your gross monthly income. Using our previous example, if your gross monthly income is $5,000, the total of your housing debt and your reoccurring monthly debt should not be higher than $2,000. And don't forget, you will also need money for closing costs and filing fees at closing. So make a list of all your debts and you'll have a good idea of how much house you can afford.